Well, welcome to our Thursday evening Zoom, sponsored by Great Lakes Renewable Energy Association. I'm John Sarver, a board member, and I would like to kind of thank our sponsors, the Michigan Department of Environment, Great Lakes and Energy, Eagle, Homeland Solar, Harvest Solar, and Shree Energy. And tonight we have two guests that are going to talk to us about green investing. Tom Stanton, who many of you know, has been around working in this field in Michigan for many years. He's now with Community Energy Solutions, which he'll, I'm sure, mention before, and Henry Shilling, who's with Sustainable Research and Analysis. And we're going to start out with Henry doing a PowerPoint presentation. We'll have time for a few questions after his presentation and then move on to Tom. And after Tom's presentation, we'll have time for even more questions. So, Henry, go ahead. Oh, by the way, everybody, please mute yourself.
So thank you very much, John, and good evening, everyone. Tom and I are delighted to have this opportunity to present to you some of our thoughts regarding sustainable investing. So that's the broad topic of at least my segment of the discussion. And what I'm planning to do is make a few introductory remarks. I'm assuming that everyone can see the slide in front of you entitled Agenda.
No, we can't. We haven't seen any screen sharing yet.
Okay, let me then try to.
Now it's coming.
Now it's coming.
It's not full screen yet, but.
How's that?
It's not full screen yet. Oh, now it is. You're all set.
So what what I was planning to do is make a few introductory remarks, talk about sustainable investing approaches and motivations, spend a few minutes, not too many minutes, on general investment process and sustainable investment options, and then focus on selected public and private sustainable investment alternatives. And by that, I mean mutual funds, ETFs, green bonds, and what I'm referring to as PDLs, which are private, direct, local, small business loans and related investments. So that's my, those are the topics that I plan to cover. Okay. So my remarks, as I said this evening, are focused on sustainable investing. And that's an investing approach that integrates social, environmental, and governance factors into investment decision-making. Because of the time limitation that we have, this is a presentation that both Tom and I will share, and in total we'll spend about maybe 50 minutes with our remarks and allow some time for Q&As. But because of the time limitation, this is really, you should consider this to be an overview of this sustainable investing, this approach. So sustainable investing spans both public markets, and these public markets would include mutual funds, ETFs, stocks, sustainable bonds, especially green, social, and sustainable bonds, which are a combination of both social and green, as well as private markets. And private markets include direct loans, private equity, as well as direct smaller scale investments open to investors that can be accessed via digital crowd funding platforms. And these introduce opportunities for investors to invest locally and with impact. What's driving global trends global trends that lead to the adoption of a sustainable investing approach. Those are largely climate change and environmental risks, generational wealth shifts, regulations, and stakeholder demand. Those are some of the key drivers, they're by no means the only ones. By some estimates, global sustainable assets under management have reached over $30 trillion. And that's as of November of 2023. So roughly speaking, it's about $1 in $4 managed by institutional investors. There's a lot of give and take around these numbers, but we'll use these for the purpose of this conversation. That's a global view, but in the US, US sustainable assets under management are estimated to be about 6.5 trillion. This is according to the US SIF Foundation. And these numbers not only include mutual funds and ETFs, but also other assets that are managed through various other types of investment vehicles, particularly separate accounts. The chart on the right of my right on the slide, which is based on Capital Group. Capital Group is an investment management company located in California. They conducted an ESG global study in May and June of 2024, and it shows that 9 in 10 investors in the study identify themselves as ESG users, and that was the same as last year. So this illustrates, in my mind, the ongoing strong conviction in the evolving ESG space. I also recognize that this is pre-Trump, but studies that I've seen conducted post the Trump election going into 2025 reflect similar trends. But at the same time, political pushback in the US against ESG investing has had some dampening effect. And these could be seen, for example, in the nature of the fund flows that are being experienced by sustainable investing vehicles. There's been a noticeable decline in new fund launches. There have been quite a few fund closures and reorganizations, and more generally, in the nature of the lower profile that investment management firms have adopted insofar as speaking out on this topic is concerned. So in the short term, this has some implications. It may mean that a smaller universe of investment management firms will actually offer a more limited set of focused sustainable mutual funds and ETFs, while at the same time, many, if not all of the investment management firms operating in the US will formally incorporate financially material ESG factors into their traditional investment management activities. It is Tom and my view, and this is a thesis that we're putting forth in this conversation, that blending sustainable public and private investment approaches can achieve measurable impact without necessarily sacrificing risk-adjusted returns. However, this strategy also requires investors to consider potential trade-offs with respect to financial outcomes. And I'll talk more about that. But the fact remains that investors have more access to tools, to platforms, and information than ever before in order to align their portfolios with sustainable goals. And it should be kept in mind, however, that sustainability means different things to different people. Now, what is sustainable investing exactly? Well, sustainable investing is an approach, you can see it on this slide, that incorporates ESG considerations, environmental, social, and governance factors, into investment decision-making with the dual aim of achieving financial returns and positive social and environmental incomes over time. Most practitioners agree that sustainable investing refers to a range of strategies that combine traditional investment approaches with ESG insights. And this contributes to a more comprehensive analysis, better investment decisions in terms of risks and opportunities, and an alignment of values based on preferences expressed by investors, which again can vary from one investor to the next. Now, I should preference my discussion around this slide, which is entitled Sustainable Investing Approaches, by clarifying that there are no universally accepted definitions of terms such as ESG, sustainable investing, or various sustainable investing approaches, which are listed on the left-hand side of the slide. This is actually one of the key reasons why there is so much confusion and misunderstanding that has arisen in the US and has created a opportunity for politicizing this particular investing approach. That said, most practitioners agree that sustainable investing refers to a range of strategies that combine traditional investment approaches with environmental, social, and governance insights. And I've listed 5 approaches here, which range from values-based investing, screening and exclusions, impact investing, thematic investing, and ESG integration. These are not mutually exclusive, so that they can be combined with one or more of these strategies. And they typically also incorporate engagement strategies, which involve having discussions and conversations with companies around their sustainability practices, either to influence behavior or just to gather information, and enact proxy voting initiatives. I will point out that with regard to values-based investing, that strategy is executed through either exclusions on the one hand, or overweighting companies on the other. So, for example, exclusions may include such approaches as excluding tobacco stocks or bonds or equity issued by private prisons, weapons manufacturers, oil and gas companies, high CO2 emitters. That's on the exclusion side. And on the overweight side, maybe emphasize companies that are low carbon dioxide emitters, or they have aggressively adopted DEI, diversity, equity, and exclusion strategies. At the other end of the range is ESG integration, and it combined with engagement and shareholder actions and proxy voting, probably represents the lion's share of the strategies that are encapsulated in the $6+ trillion that are invested pursuant to sustainable investing strategies in the US. And ESG integration is defined as taking ESG factors into account in a systematic and consistent manner where these are deemed to be relevant and material to investment decisions. And the focus is on risks and opportunities. On the right-hand side of the page, you can see some of the terminology that is associated with the E, S, and G factors, and what areas are typically focused in on when those factors are being considered. Now, I spoke about the broad themes that drive sustainable investing. Those serve to inform decisions that are made. Those inform the way in which sustainable investing is integrated into the investment management process. And this is a slide that provides answers to a survey that was conducted by the CFA Institute back in 2019, when largely institutional investors and financial advisors were asked what led them to consider sustainable investing. And this slide shows that risk management was a top consideration. Client demand was a second important considerations. Regulations was a third. Achieving better returns was a fourth. And then fiduciary responsibility, which refers to um, refers to the role of institutional investors in managing portfolios with a view toward achieving the best possible returns that reflect the ultimate desire on the part of the investors for whom they're investing capital. And there are slight variations between the answers that were provided by respondents who manage fixed income portfolios versus equity portfolios. But overall, the ranking is the same. Generally speaking, conventional or sustainable investors, and for that matter, financial advisors, go through a similar process, a similar 4 or 5-step process when it comes to constructing and managing portfolios. And this is for both savings and or retirement. And the 5 steps include formulating a financial profile by defining goals, risk tolerance, and investment time horizon. Second is defining sustainability preferences. The third is designing a complementary investment portfolio. Asset allocation. Asset allocation refers to the broad asset classes such as equity, fixed income, and cash equivalents, to mention just 3. Analyzing investment options and selecting investments. And what you can see on the right-hand side are some of the key options that are available in terms of public securities, mutual funds, exchange-traded funds, ETFs, closed-end funds, publicly listed securities like stocks, bonds, green, social, sustainability, and sustainability-linked bonds, public and private securities, and then finally private offerings, which includes the digital online platforms, private, direct, local, impact-oriented small business loans, which is what Tom is actually going to be focusing on. And finally, monitoring, updated, reallocating the investment portfolio on a regular basis. There are some resources that I included in the back of the presentation that actually set out how a financial profile is developed, how sustainability preferences can be defined and refined, as well as other resources that you can look at your leisure. For many investors, a key objective, and this is now on slide 8, for many investors, key objectives is to grow their capital by generating the highest possible investment returns, while at the same time taking on the lowest possible amount of risk or volatility in their investment portfolios. Modern portfolio theory shows that the best optimal portfolios of investments are those that offer the most return for each unit of risk. And these fall along a curve that's called the investment frontier. The efficient frontier. The efficient frontier curve displays the trade-offs between expected return and risk. It is represented graphically on the right-hand side with risk on the x-axis and expected return on the y-axis. And at each point along this curve, there is a portfolio that provides the highest possible expected return for a given level of risk. And similarly, there is a portfolio that offers the lowest possible risk for a given level of expected return. And the idea is to craft a portfolio that will align itself along this curve, along this expected return and risk axis. Anything above may be more, may provide anything above the curve or below the curve will produce a less optimal portfolio. So when investors introduce constraints around the portfolio construction process, as is the case with certain but not all sustainable investing approaches, when, for example, investors want to exclude tobacco stocks or the stocks of companies engaged in oil and gas exploration or high CO2 emitting companies, or conversely, they might wish to overweight companies that have made commitments to reduce CO2 emissions or adopt aggressive DEI, diversity, equity, and inclusion policies. Such alterations to the portfolio, depending on the extent to which they're adopted, can lead to inferior risk and return outcomes. Such alternatives can take the form of shifts within some range toward desirable sustainability outcome with limited negative financial consequences. And examples are the exclusion of one or possibly two minor sectors. And what I mean by minor sectors are sectors that on a market capitalization basis make up a small component of a large index like the S&P 500. So a good example is companies engaged in pornography or companies that are involved in managing private prisons. They make up a very small component of the S&P 500. Or for that matter, modest investments in some of the direct local impact-oriented smaller businesses that Tom will be discussing. So those could have a very small impact on the overall risk-return profile. However, as portfolios shift beyond some range of a limited set of exclusions by superimposing additional constraints, returns can be expected to suffer. Fortunately, these trade-offs can be measured, and investors can decide on the risk-return trade-offs that they are willing to accept to achieve their financial sustainability preferences. One approach to sustainable investing is to invest in mutual funds and ETFs. It's not the only one, but this can be the case for an entire or partial investment portfolio, depending on an individual's financial goals and objectives and sustainable preferences. In the US, there are over 800 focused long-term sustainable mutual funds and ETFs. There are enough strong fund candidates in this segment from which to choose to create anchor or core positions in a diversified sustainable portfolio of funds. These include actively managed funds. They can include index funds. They can include equity funds as well as bond funds, to mention just a few. And at the same time, there are some limitations. For example, there is only one small cap value fund within this segment and only one small cap growth fund. So if exposure to these categories is desirable, conventional funds will have to be tapped. When I use the term focused sustainable mutual funds and ETFs, the reference here is to registered sustainable mutual funds and ETFs that either include some reference to sustainability in their names or disclose their sustainability mandate in very explicit terms in their offering documents or prospectuses. So, for example, terms like ESG, impact, sustainable, climate, social, etc., will appear in their names. Or in the case of a fund like Parnassus Core Equity Fund, the fund includes an explicit sustainable investment policy in its prospectus or offering document. On this slide, I'm displaying a list of the largest sustainable fund management firms operating in this space, as well as the largest long-term sustainable mutual funds and ETFs. And firms like BlackRock, through its iShares offerings, in particular, Vanguard, Parnassus, Calvert Research and Management, Nuveen, which is a TIAA-owned company, DFA, Dimensional Fund Advisors, Franklin Templeton, Brown Advisory, Impacts, and Invesco are by far the largest players in this space, and their assets and their offerings account for about 75% of the total in this space. And you can see here a list of some of the largest focused long-term sustainable mutual funds based on their included here are the categories that they focus on, whether they're active or passive funds, their size, and their last 3-month and 12-month performance numbers through March 31, along with their expense ratio. Another option is to invest directly in individual stocks and bonds. I'm only going to focus on sustainable debt instruments. And this slide sets out the various types of sustainable debt market instruments, which I classify into 3 categories. The first one on the left-hand side is the use of proceeds bonds. Then on the right-hand side are sustainability and transition debt instruments, as well as blended finance and hybrid instruments. I'm just going to talk about use of proceeds bond. So these encompass a family of fixed income instruments, corporate, sovereign, municipal, project finance, asset-backed securities, etc., whose proceeds are earmarked for projects or investments with environmental and social purposes. These bonds can combine not only green bonds, but also social bonds. And when they're combined in that way, they're referred to as sustainability bonds, but there are also niche offerings like blue bonds, which focus on water, wastewater management, ocean, plastic pollution, marine ecosystems, and so on. And then there are SDG-linked bonds, which attempt to track one or more of 17 United Nations Sustainable Development Goals that aim, in the words of the UN, achieve peace and prosperity for people on the planet. And those goals would include elimination of poverty, zero hunger, clean water, etc. I'm going to skip over the 2 categories on the right-hand side of this slide. But I think it's important to note that these instruments are available for investment either directly or indirectly by buying mutual funds that invest in such securities. I'm going to drill down for a moment on green bonds. Green bonds are fixed income instruments in which the proceeds are exclusively applied to finance or refinance new and/or existing eligible climate and environmental projects or investments. There's an element of exclusivity here because of the use of proceeds element. In all other respects, green bonds functions like conventional bonds, and that is what accounts for their great success, with over $2 trillion having been issued since they were introduced in 2007. The credit ratings of green bonds are equivalent to their conventional counterparts. There are some exceptions, but on a pricing and valuation basis, they're generally in line with their conventional bond counterparts. They're typically issued pursuant to a widely accepted set of green bond principles, which require that green bonds, social bonds, sustainability bonds disclose certain aspects of their offering around use of proceeds, process for the evaluation of the bonds and project evaluation of the projects and project selection process, the management of proceeds, and then reporting. It is possible to invest in a number of green bonds that have been issued in the state of Michigan, either at the state level, agency level, or even the University of Michigan, which in 2022 issued a $300 million Series 20 2022B green bond in $1,000 denominations. These were taxable bonds paying 3.5% interest based on conditions at that time. The bonds are due in April 1 of 2052. $274 million of the bonds was to be allocated to support green buildings on the university campus. 20 million was to be allocated to support renewable energy projects, and 5 million to support clean transportation. is rated AAA, so the green bonds were also rated AAA, and they carried a second party opinion. They today can be purchased on the secondary market, either directly through a broker or with the help of a financial planner. As I said, they're available in $1,000 denominations, but there may be some minimum required purchase. My last slide focuses on the topic that really Tom is going to cover, which is investing in private, direct, local, small business loans and investments via digital platforms. There has been a growing number of digital private market platforms. There are now today over 100 that allow investors to identify and integrate into existing portfolios small, private, direct, local investment opportunities. We're calling these PDLs. And these private market digital platforms also permit sustainable investors to identify and introduce into their portfolios impact-oriented PDLs. In either case, as I see it, the challenge is in conducting proper due diligence at this time on such investment opportunities, because they can be challenges due to disclosure and transparency reasons. So I've listed on the right-hand side just a selection of digital platforms that are available. And one in particular that I mentioned is King's Crowd, which is an aggregator. In other words, you can go onto the King's Crowd digital site and actually invest in any one of these other sites that I mentioned through the platform that King's Crowd makes available. And with that, I guess we may have 1 or 2 minutes for a question if you have one. Otherwise, I'll turn the conversation over to Tom.
Yeah, Henry, why don't you stop screen sharing? Before you do that, Henry Shilling at sustainableinvest.com is a good way to contact Henry.
Exactly.
If you'd like to Henry mentioned, we'll take a few questions. Raise your virtual hand, and then Tom, why don't you, while we're taking some questions, get your slides up. Any questions or comments? Okay, Charles. Go ahead, Charles.
Yeah, hi. Years ago I invested in Calvert, and it tanked. This was like decades ago, and I assume there's better quality control now than there was at the time. It was a social investment fund.
Mm-hmm.
So any update at how things are different now than they were maybe 30 years ago?
Well, certainly a lot has changed in 30 years. There are many reasons why an investment can tank, and it may not have anything to do with the fact that it's pursuing a sustainability strategy. It could be a reason. For example, in 2022, because of the heavy concentration of technology companies in sustainable funds that invested in those firms, largely because they had pretty good governance and they were low carbon dioxide emitters, while at the same time reducing and lowering their exposure to oil and gas companies. It was just a time when technology didn't do so well and oil and gas companies did very well. And so sustainable funds didn't perform as well. But you have to look at their performance over a complete market cycle. And while Tom continues to remind me that while the objective is to achieve market-based rates of return, the idea is that you could potentially outperform as well. But you need to look at that over a complete market cycle. And I don't know that I can say much more about what may have transpired at Calvert. They did have some issues. Calvert was eventually acquired by Eaton Vance, and Eaton Vance was in turn acquired by Morgan Stanley. And I think they've got some excellent performing funds in this space, both on the equity side and the fixed income side today. They also offer the largest, by the way, the oldest and largest pure play green bond fund in the market. So if you want to invest in a portfolio that only offers green bonds, Calvert is one of those that has them. BlackRock has another, and Van Eck, as well as Nuveen, which is a TIA Cref company, owned company, are the largest players in that space. And each has a fund that has performed exceedingly well.
Hey, thank you, Henry. And Tom, why don't you go ahead and we'll have time for some questions after Tom's presentation. Go ahead, Tom.
All right, thank you. I'm going to go quickly and covering my own personal experiences with green investing, some current opportunities that are out there for your immediate action if you're interested in doing this, and near future opportunities that I am working on and I invite you to work on with me so that we can open this up more to people in Michigan. You probably know the term caveat emptor, which means let the buyer beware. Caveat auditores means the audience should beware. And so here's my disclaimer slide and some very cute cartoons that I love from a cartoonist named Dave Carpenter who allowed sharing of those. So one of the things I want to talk about is how it is that we decide which investments are green. And Henry already talked a little bit about the United Nations Sustainable Development Goals. These are the 17 goals. You see on the left, I am a student of comprehensive design guides and frameworks that help us to determine what is sustainable and maybe more importantly, what is not sustainable. And you'll find links to those. John Sarver has a PDF version of this that he can share with you that has the hot links in it. These are examples of analysis of particular projects vis-a-vis the Sustainable Development Goals, showing which goals are most achieved by a particular project by the longer wedges and which goals are achieved little by the very shorter wedges. These techniques are being used now to develop climate offsets. So there are going to be formalized methods for doing this analysis project by project so that people can determine which projects they want to fund in order to achieve the greatest climate action and achieve these different 17 major goals. The 17 major goals, by the way, are broken down into 170 specific actions. So it's a huge database of those. So what we're kind of looking for in this realm are situations where, as an investor, you can know everything you need to know about a particular local small investment. This is not easy, and Henry already said there's some challenges with finding the right information and maybe finding complete information, but I would say that is getting better all the time. I focus a lot on what is called project financing, and project financing is unique because we can know ahead of time about the project, what are its costs, what will be its savings. This is particularly true for energy projects, but it's also becoming more and more true for water projects. And one of the things I study is food, energy, water nexus, FEW nexus. That's already a growing business, and people are looking into the ideas about how to make more and more of our systems smaller and more distributed at the neighborhood and the community level, where we can know a whole lot about the investment before we make the investment. there are particular avenues that are especially promising right now: energy optimization and energy waste avoidance. We can add to that clean energy production from solar, from renewables, from clean bio power, hydropower, and so forth. I am particularly interested in adding Michigan-made technologies, and there must be at least 100 that are out there being developed, striving to get market penetration, ready to launch today. And they are all over the board, including everything from air conditioning to zeolights, and great opportunities. Now, I'm going to cover some of my own personal experience, and here's a photo of our historic home. We've done a bunch of different local investments in our own home, energy efficiency, in different buildings too. But each time we did it, we spent about $3,000. In this list, you can see I'm doing old style donation-based crowdfunding. I've done some of that. I've hired a fiduciary advisor that is helping me do special placements for my entire portfolio in sustainable investing in the regular marketplace of mutual funds and ETFs and so forth. But also they're helping me with self-directed IRAs, and I've moved about 1% of my investments into a self-directed IRA fund that I use. I've done a couple of special private equity placements. I'm now an accredited investor, so I'm able to invest in these private offerings. And I've invested in 2 specific Michigan companies whose work I believe in very, very deeply. And, I'm waiting for them to open up their markets. In the home energy efficiency, my family was one of the very first to lease a panel in the East Lansing Bircham landfill solar energy project, the community solar project. I was able to put solar on my house and batteries in the basement using a Michigan Saves loan as part of the Lansing Solarize program. I'm now working on DC battery charging, and really having great success with that, with a small battery that provides DC power, and I can charge it with my solar panels, and then I can use that DC power to charge all my different electronic devices. I've already bought myself a hybrid electric bicycle. I've already bought myself a electric scooter, and I've got some fine art and musical instruments collections that are, not great, but they're around, and, they are potentially valuable. I've had both successes and failures, and this slide talks about them to some extent. The first one that I did was at the Avenue Cafe in Lansing, and they were struggling to get the money so they could get their beer and wine license, and they wanted $1,500. So I talked to them about a model that I had read about that said, why don't you go to your customers and borrow from your customers and pay your customers back in food from your restaurant? So it's an interesting kind of an inside game where they were able to borrow their $1,500 from presumably 10 different customers. Each one of us then got a $150 credit that we could use in the restaurant anytime we wanted. And it was like they were giving us something that they valued at wholesale, but we valued at retail. And it worked out just great. And they got their beer and wine license, and now they're a successful venue. There's pictures here of bands playing in the venue. They've been doing great. Sorry. Then I did start in 2025 using self-directed IRAs. I'm sorry, that was about 2023. In 2025, I have to start taking minimum distributions from my IRAs, and I know many of you will be that mature soon, where you'll also be having to take minimum deductions from your IRA. We're actually going to be in a situation where if we take that money and we use it ourselves, it's going to bump us up into a higher tax bracket. So I'm learning how I can take that money and invest it in local 501c3 educational organizations like GLREA, and make sure that those investments achieve positive impact. And I'm already having really positive discussions with Michigan State University about doing that, and other local organizations that we want to support. We've made a list and we're starting to work our way through that list. You may have seen that I was doing that with the Kid Wind project. They're trying to raise money to send the Kid Wind team from Hazlitt High School to the world competition in Arizona. So I was offering them matching funds to do that. Here are some of my current investments through this platform that's called Honeycomb Credit. They used to be called Raise Green. When I found all these companies, they were all listed on Raise Green. Now Raise Green is merged with Honeycomb Credit, and there are many more choices. But this is just an idea of what's out there and what I have been able to invest in the past a little bit. You see the interest rate on each note, the length of term. NEIF is the National Energy Improvement Fund. And this was in their equity certificates number 3. I think they're now at number 11 or number 12. And I'm working on, sending more investment to them. NEIF, by the way, is ready to come work in Michigan, doing Michigan low income energy efficiency improvements. They're now paying upwards of 7, 8, 10% on returns. And they have a very positive track record of making this work. All we need to do is bring them Michigan money and they'll make Michigan projects. New Hampshire Solar Garden was an opportunity for me to invest in a solar garden array, not in Michigan, but in New Hampshire. As long as they kept the outside investors to a minimum, they could accept funding from others, and they were paying 6.5%, which is better than the return on my Board of Water and Light community solar project. So kind of interesting we can do that. Kilowatts for a Cause is already operating in the city of Ann Arbor, and they're ready to expand more into Michigan. Their CEO is in Michigan, and we're having conversations about creating a special agrivoltaics fund for them. Block Power is doing low income buildings, and now Block Power is doing electric vehicle charging systems for multifamily housing, especially low income. And they're now offering, then this last one, 9.25% for 5 years. Notice my investments in these are rather small, but each one doing some good and working with a company that I believe in. So that's how I choose them and how I put my cash into them. And I'm still working on some new leads. I have had a couple failures, and I wanted to tell you about the failures. Both of these really surprised the heck out of me because they were so good. I don't see how they could have failed, and yet they did. Olafilter was making a fabulous water filter, very small, very easy to install, that could help save lives all over the world, but they couldn't get from the early stage across what people call the valley of death into mass production and mass delivery of their devices. So they went under. Como Audio happened to be making world-class audio systems. I did end up with some audio systems, at least out of that investment, but they folded up during COVID, and I'm not sure how or why, but they're gone now. So I did have some losses, and you're likely to pick some losers as well as picking winners, but I think this is worthwhile in getting things going. The process would be you find your own fiduciary investment advisor. Fiduciary means they have to act with your best interest at heart, not their own best interest. And the one that I use is headquartered in Michigan. They do business worldwide, but their name is Revalue, Revalue, and you'll find them online, and you'll find them in Ypsilanti, Michigan. You can then use any of these federally approved crowdfunding platforms, and I've given you a bunch of links there. Honeycomb lists different projects, and they give you a rather complete set of information about each project. This is just one example. This was a project in Detroit seeking funding for an art gallery. And they were offering 13.5% interest. And notice there's 25 days left when I made this slide for investing in them. I've been trying to pick investments that are 30 days or 60 days in the future so that I could work with my fiduciary to check which ones and make smart investments. This is a list of previously funded projects from Michigan, all on the Honeycomb platform. And, you know, many things are to do with food and other things, different kinds of small businesses. But Kilowatts for a Cause was here. I put them in twice just so that you know, catch that. But you know, these are all ones that were listed there and successfully raised the funds for their projects. These are more projects from all over the country that I thought were especially interesting. And I do invite you to go look at these one by one and think about what these options are. There are really remarkable opportunities to make these investments, and they typically require a very small minimum to participate. And then you can see some of these returns in the range of 10, 12, 13, even 14%. So exciting to me, you know, that these are available and ready to look at. Honeycomb is now in the process of creating and standardizing these frames that you see around some of the projects. The red one in the middle is for a project that includes what they call investor perks. If you put money into this Pennsylvania Boys Barbecue, they were going to give you a free catered meal up to a certain dollar amount, and I think a T-shirt and, you know, other perks for being one of their investors. The same with Summerland's Brewing Company. They were setting up to offer people an opportunity in Holt, Michigan, so that you could join as one of their investors and get special treatment when you go to their brewery. Raise Green, the climate action oriented investment group, has the green frames, and those are now going to be screened for a whole series of climate actions. And the link is there where you can see those. The blue one on the right, SoCa, is intriguing to me because the city of Pittsburgh, Pennsylvania, has developed its own climate impact fund match. So they're now saying, hey, when you invest in SoCa, we're going to invest in SoCa as well and double their amount of money that's available. The one on the very left is a similar kind of thing where another Honeycomb investor has set up a match for that one. So I just wanted you to be aware that when you go look, you're going to start to see the different colors. They're standardizing on purple, green, and red. And that's one way to help you screen investment options. There's a whole bunch of places you can look for more and more places. And in this slide, when you get it from John, you'll see a list of a whole bunch of others. These are on the Start Engine platform. And gosh, there's some intriguing early start companies that you would have a chance to invest in. We're running out of time. So here we go really quick. What can we do ourselves to help enlarge this opportunity and move forward? I'm searching for partners. I'm working on this in several different realms. And we do have the opportunity to establish Michigan funds and use our Michigan funds to push money into these kinds of projects and do it in a way that gives us some diversification for ourselves. So this is a very profound and interesting opportunity that's available now. We just need the first, whatever, 10, 100,000 people to get started, and we can have multi-million-dollar Michigan investing in Michigan green projects starting tomorrow, where, you know, this is really ready to go. The other sweet spots are listed here, a bunch of the things that are being worked on. Michigan has had incredible legislation introduced that would create those things at the bottom, including our community solar legislation, microgrid legislation, and others. The energy related legislation has been stalled, as we all know, stalled in the state legislature now since 2012. I helped work on the original bills proposed in 2012, and they've been going nowhere ever since. So part of my attitude is we can't wait for the legislature. We just have to get out and start doing this ourselves. Ask yourselves, what is it in the Michigan economy that we could be working with? And here's a bunch of ideas. And there are people already interested in working on some of these together. So it won't take much to just lift a little bit and get them started, especially the agrivoltaics investing. And I'm working on a group in Michigan and nationwide that's focused on Michigan agrivoltaics. We have just fabulous opportunities to do project management in any of these areas. I worked on this for the Capital Area Friends of the Environment. Marshall Clabeau and I are board members of CAFE. CAFE is interested in working on this. I'm the worker, but here's what we're trying to get started. Where you can go learn more about all these ideas and a list of upcoming events. So thank you for your attention. I urge you to get going with this a little bit at a time. Just get started and let's start making it work. And we look forward to any further discussion and questions. Thank you.
Thank you, Todd. And Dave, you have the first question. Go ahead, Dave. Dave Curtis.
Dave Curtis, you got to unmute.
Sorry. I just hope that you'll come back and update us as time goes by, because it's very interesting, Tom. And hopefully I can get on the list to get that PDF from John.
Very good. Yes, thank you. And Henry and I are working on several written reports on these ideas, and we're going to try to figure out how best to share those with people too, because the good ideas are proliferating.
Any other questions or comments from folks? We're getting close to 8 o'clock, but we can go over a little if people have questions or things they'd like to discuss. Raise your virtual hand. Okay, Marshall.
Have you seen any battery projects with rate of return investments that you can invest in? I'm just curious on how some of the behind the meter stuff can evolve and grow.
Well, because we know the economics can work, then we know the projects can work. I haven't yet seen any specific ones that I recall, except the one that's in my own house. I know about that one, and it's saving us $100 a month on our utility bills. And when the power goes out, we're able to run critical needs in our house off the batteries. So, it already saved a refrigerator worth of food once in our house. I think that's an easy opportunity to create projects that will combine solar plus batteries and use the batteries to run critical loads of any kind. But I haven't seen them yet, but I will keep my eyes peeled, and when I see one, I'll share it.
Hey, Richard Pierce asked the question about, you had some slides there where it had funded, and so that means it's closed for investments.
I think many of those will be completely closed and they won't be accepting new investments. And I think others, even though they say they're funded, they have a minimum level to achieve that goal of being funded, but some of them allow more growth after that up to some cap. That's all part of the regulation CF for crowdfunding from the federal government. And all these companies have to follow the federal rules in order to be listed on these platforms. So it's worth asking if you see a project that you really, really like, but they say they're fully funded, reach out to that company and ask them if they're still accepting investments, or make sure they will let you know when they're ready to ask for more, because several of the companies are already doing this multiple times. They may have already had 10 different fundraisers on these platforms, and now they're getting ready for number 11. So, they'll come back for more as they're successful.
Okay, thanks, Tom. Other questions, comments? We're over 8 o'clock, but I'll give, if somebody has a last question or two, okay, Lee, go ahead.
Yeah, in the beginning of your presentation, Tom, you mentioned RMD, and then you also said something about um, donor directed funds. Is there a link between those for us that are over 73?
I'm just learning about it myself, and I'm just doing all this work to try to figure out how we can best use our own family RMDs to generate impact investments at the different charities that we like to donate to. The donor advised funds are a different kind of animal, and I understand that money that gets put into those would be taxable money, but still they can be targeted to specific kinds of investments. I'm in conversation with Michigan State University about this, and they do already have a donor advised fund. So as I learn more, I'll be working with Henry to describe what we learn, and then we'll be sharing that.
Yeah, thank you. Those are separate in my experience. Those two things don't really go together. So your response is, I understand that. Thank you.
Yeah, Henry and Tom, we'll have to have you come back at some point to kind of give us the latest, because I know this is an evolving area. And both of you, thank you very much for taking the time to do this presentation. The presentation, is will be posted on the YouTube channel, GLREA YouTube channel, for those who want to go back and kind of go through some of the material, because there was a lot of material to cover. And next week, we're going to be having a session on what in the world is going on in Washington, D.C. It should be an interesting discussion. Hope to see you all next week. And again, Henry and Tom, thank you very much.
Thank you, everybody.
Thank you so much.